how they set policy, monetary policy, is really going to affect a lot of different things. Real estate, this whole debasing thing that we're going to talk about. 4 times a year they write this thing called the Monetary Policy Report. Not an exciting read, unless you're like really deep economics one. And they've been doing this since 1995, so 30 years. Now the reason I highlight this is the most recent one that we got over the summer. And you may not be able to see it, but there's a word that's highlighted over and over again. And that's right, the word is uncertainty. They referenced the term uncertainty 80 times in this publication. Being the nerd that I am, I went back and looked at every single one that they've written going back to 1995. They've never been anywhere close to that. And you think of what we've lived through over the last 30 years, that captures. Some folks in the room are going to remember Y2K. Remember we thought that was going to be a real thing, like a lot of uncertainty there, nothing burger. But then you had 9/11 and the financial crisis and COVID. Like we've lived through some real periods of uncertainty. And the messaging from the Bank of Canada is this is arguably the most uncertain time that they've seen for setting monetary policy. And by the way, when we say monetary policy, that's another way of just saying interest rates. Okay, so that's the economic wonk way of saying that. So what does that mean? Well, this is not just a hypothetical. There's a lot of uncertainty in the economy right now. People are feeling it. One of the ways that we see this is in things like confidence readings. So the chart on the left is showing consumer confidence. And it's just a simple way of thinking how people view, like how confident are they, how do they view the future. I want you to notice in that chart that in March of this year, we set a record low for consumer confidence, going back at least 25 years. Which is a wild thing, because that's telling us that in March of this year, people were more pessimistic about their future prospects than they were in 2020 when we were all locked down with this crazy virus floating around. Like a really, like an irrational, you're like, really, this is scarier time than then? Like that feels irrational? And even more pessimistic than we were in 08, 09 when we thought that maybe the financial system was going to melt down. Like we legitimately thought that was a risk. But you can't, people, their feeling is the reality. You can't talk people out of this. They felt this way, and that has real ramifications for the economy. We see it as well with small businesses. Small business sentiment, similarly, that's the chart on the right, set a record low again in March of this year. Now, this is, again, if it's the central bank, and you see something like this is not just a hypothetical thing. This affects the economy, right? Because in order to spend, in order to go out and invest, you have to have confidence. And when you don't, it ends up acting as a drag on the economy. So what did we see? Well, the chart on the left is showing Canadian GDP each quarter. It's an annualized number. And we just saw in the most recent quarter the largest decline in GDP and economic activity that we've seen since 2016 outside of the pandemic. And what drove that? It was a big drop in investment. A lot of businesses stopped investing. That's understandable given all the trade tensions. And it was a big drop in exports. So we're seeing that this uncertainty is weighing on the economy. And one of the concerns as well for Bank of Canada is that it's leading to a lot less investment than we need. We're not investing in the things that make us more productive, unfortunately, as a country. And you can see this. This is a wild chart that I put out on Twitter and ended up kind of going everywhere during the election. It was kind of used as a, it kind of ended up going a little viral. But you can see that's a wild looking chart. So that's our per capita GDP indexed to 1995, right? And you can see that us and the US tracked each other pretty closely. And then we've diverged, and we really have not gone anywhere for the last decade. Now, a lot of that is just due to us as a country not investing in the things that make us more productive. Now, this all matters. Again, what we're trying to do is put our head, get into the headspace of the Bank of Canada. What are they focusing on, and what's this going to mean for interest rates? That's where we're going to. That's where we're going to land here in a moment. So let's talk about the labor market. Again, we're talking about the high-level economy. I'll just tell you, I am seeing signs in the labor market that things are getting. It's not terrible, but it's what I would call a slow burn. Okay, we're seeing that nothing's exploding, and you're seeing signs that things are starting to soften. The chart on the left is interesting. This is showing the annual change in private sector payrolls. So we remove any public sector hiring, we look at just what are businesses doing that aren't directly related to government. And we find that actually that number is negative compared to last year. There are fewer people working in the private sector than there were a year ago. That really doesn't happen outside of periods where we're in or very close to recession. You can see that historically. So, signs there that the labor market's softening. The chart on the right, the unemployment rate. For Canada as a whole, we're sitting at just a little over 7%. That's the highest we've seen since 2016, again, outside of the pandemic. But it's a little bit worse in places, like parts of the country that are more exposed to this trade tension. So in Ontario, it's a little higher, and unfortunately here in Toronto specifically, it's higher still, sitting at 9%, which is really the highest we've seen since about 2011. I think we set aside the pandemic. So there are signs that the labor market is cooling. Now, in the central bank, you're watching this really closely. Now, one of the good things that we've seen is that homeowners are doing really well overall. People who have taken on mortgage debt, despite the significant backup in interest rates, we find that homeowners are managing this extremely well. So this is mortgage delinquencies. You can see the blue line is the national number. Today we're 0.23% mortgage delinquencies in this country. For reference, in the US, they're still over 1%. So we have been through now 3 years of rising and relatively high interest. I know there's folks in the room who will dispute the high interest. My first mortgage was 17%. And be like, okay, we get it. But that rise in rates off that kind of 1% up to 3, 4, 5, 6%, when you're dealing with the size of mortgages that we are today, that's material. And the fact that we have not seen the dramatic increase in mortgage delinquencies is pretty surprising. So that's good news. I will point out for Ontario, the increase off the lows has been a little bit more dramatic, but still nothing like really alarming at this point. But there are some pockets of weakness. And it's not surprising. This again related to the parts of the country that are more exposed to this trade tension. So ROI, that's the stock ticker for Royal Bank. That's the chart on the right. That's the stock ticker for CIBC. And I do this stuff for my institutional clients. These are the two big banks that disclose the regional breakdown of mortgage delinquencies in their loan buckets. They're the only two. And so we get a sense from them, well, what's happening specifically with their Toronto area loans. And you can see the trend. Now, again, I would point out, it's not the absolute level is not alarming. 0.4% is still less than half of what they have in the US. It's not an alarming number, but the change, the rate of change, if you're the central bank, you're looking at that and you're going, okay, that trend is a little bit worrisome for the central bank. And unfortunately, there's a chance it could get a little bit worse as we move into 2026. So we could see a little more stress from borrowers. The reason is we're in probably the 4th or 5th inning of what I dubbed the great mortgage reset of 2025-2026. We're going to have a lot of renewals coming up for people who took out loans in 2020, 2021. The chart on the left is showing mortgage originations. This is on a 12-month rolling basis. That's how many people took out loans kind of in the previous year. Not surprising, you can see that huge bump we had in 2020, 2021. That's when we had mortgage rates that for a 5-year fix started with a 1 in a lot of cases. And a lot of folks went out, they refinanced, they bought more property, or they just took out new loans. And that's that, you can see that big bulge. Now you roll that forward 5 years, and a lot of those loans are now up for renewal. You can see on the right, we're just starting to see that uptick. We're a little close to halfway through that. So about 70% of all loans in Canada were resetting this year and next. And there was a point in time where we thought that those monthly payment increases would be on the order of 50 to 60%, which would have been catastrophic. Right? Because remember, there was a point in time there in late 23, early 24, where mortgage rates were in like the 6s to the low 7s. That would have been really disastrous. Rates have come down considerably since then, and we're looking at a much more manageable increase in payments for those borrowers, but enough that it could still move the needle for people that are a little more at the margins. So the chart on the right, this is data from the Bank of Canada. And what they found is that rather than a 50 or 60% monthly increase in payment at renewal, we're probably looking at somewhere more like 10% on average, 8 to 10% next year, which is way more manageable. But there's this one saying, you never wade across a river that's 3 feet deep on average, right? Because the average can hide a lot of variability. And so the question is not, well, what's the average? The question is, how many borrowers are going to face big payments even within that average? And what I would point out is even though we're looking at like an 8 to 10% increase on average, you still have about a quarter of borrowers, the chart on the right, that red square, a quarter of borrowers are going to see payments rise more than 20%. So there will still be some pain for people who are renewing in 2026 and even this year. The Bank of Canada knows this. This is going to act as a drag on the economy, it's going to act as a drag on consumer spending. They're aware of it, they're worried about it. I can tell you they're worried about it. So, let's talk really quickly about inflation. There's a lot we could say here, but I'm just going to make one quick point. The Bank of Canada's mandate is to target headline inflation. Okay, and if you're really into economics, you'll know that there's a distinction between headline and core inflation. So this wonky rabbit hole we don't have to get down, but I know there'll be a handful of people in the room be like, wait a minute, they really like core inflation. I get it. But their actual mandate is to target headline. Headline inflation is not a concern right now in Canada, at least as they measure it. Now, I know some of you will have a different view of whether they're measuring it correctly, and I'm sympathetic to that view. But their mandate is to keep it between 1% and 3%. Right now, we're sitting around 2% for headline, and I don't think they're worried at this point about that spiking to the upside. They are more worried about the impact of these rates on the economy than they are about a runaway bout of inflation in the near term. So I'm not worried about, I don't think Bank of Canada is concerned, they're not like they worried about inflation. They're far more concerned about the stuff I just showed you around the labor market, the impact of these rates on renewables, etc. And so let's put a bow on this, let's tie it together, because everyone's like, well, what does this all mean? Okay, this chart is showing where the Bank of Canada rate has been and where markets are expecting it to go. And for context, a simple way to think about this is if you add 1 to 1.5% to this number, that gets you like a pretty good mortgage rate. Okay, so this is what the Bank of Canada rate is at, plus 1 to 1.5%, that's typically your kind of 5-year mortgage rate, fixed or variable. So you can see back at the beginning of 2024, the overnight rate was at 5% for the Bank of Canada. That translates into that kind of 6.5% rate for mortgages. Very scary time, and we've seen those rates have been cut since then. You can see in mid-24, we had a couple of 50 basis point cuts, so 0.5% point cuts, and then we had a long pause. Now, the question is, where are we going from here? Markets are telling us that we're going to get one more cut this cycle, and that's probably, at this point, likely to come later this month. So we got a Bank of Canada meeting on the 29th. They're expecting it's like a 60% chance we get another cut, and then that's going to be it for the cycle. So according to markets, Bank of Canada is going to stop around 2.25%. Add that 1 or 1.5% to that, and that's kind of your mortgage rate. And that's where markets are telling us that rates are going to bottom for the cycle. My personal conviction is we need to be considerably lower than that. I think we have 3 more cuts coming, and I think that we're looking more like 1.75% for the Bank of Canada, which, if I'm right, means that this time next year, or even early 26, we're probably looking at mortgage rates in the high 2s to the mid 3s, which I'll just tell you is a very different environment for demand than what we're seeing today. Okay, so remains to be seen, that's my view. I would also say, I see a lot of people taking pictures, you're welcome to take pictures and post it, but I did tell Tom and Nick they have my permission to post this, in case you guys have some portal that you can access stuff on, so this will be made available for folks, okay, if you want to reference it later. So that's where I think we're going. Now, that's kind of a real quick high-level view of the macro backdrop. And, from that perspective, the slowing in the economy is concerning, the slowing in the labor market is concerning, but it's going to be offset by one of the necessity, I believe, from lower rates. Okay, so let's talk about what that's going to mean for housing. I have 4 main takeaways for you, and then I have one kind of bonus takeaway that I threw in just for Tom and Nick because they love it. Here's the first one. I know the real estate market is very slow right now. It's actually not. It's actually not as slow as people make it out to be. If you look at the chart of home sales, it's soft, but it's not disastrously bad. But I will make the argument there's very clear signs that pent-up demand is building. Okay, so what you're looking at here, we've zoomed in on Ontario specifically. This is not home sales, but this is home sales adjusted for the population. And that's that red dashed line is the average. You'll notice that anytime that we spend a lot of time above that average, we inevitably spend some time below that average. Okay, this is what we call mean reversion in economics. This is a pretty powerful mean reverting data series. And so this is a simple way to think about it, is when we're spending a lot of time above this line, We are pulling demand from the future. People who would have bought next year or the year after are rushing to buy today. So we saw that in spades in that kind of post-COVID period that you see there, where we had a lot of fear of missing out, we had low rates, there was a lot of speculation, a lot of investor demand, and so those home sales were considerably above where you would expect them to be given demographics. And that should have been a warning that we were going to have a period where there would be some payback and there would be a bit of a gap in that demand. And that's where we are today. Now I want you to notice the most recent level of home sales per capita. We are below where we were during the COVID lockdowns, where we couldn't even leave our house. How do we have home sales that are lower today than we couldn't leave our house? Right? But that's where we are, right, on a per capita basis. And we're way below where we were in 2009. Now notice we've been there for over 3 years, so we have more than paid back that period where there was some pulled forward demand, and we are now building, very clearly building pent-up demand. Okay? This is akin to holding a beach ball underwater. Now the question is, what's going to release that? And here I don't think we have to overthink it. Actually, before we get to that, let's talk real quick. I did mention about home sales not being, like they're soft. Okay, we're looking at the national home sales numbers adjusted for seasonality. Yeah, we're way off that crazy 2020 and 2022 peak. But if you draw that line backwards, like, this is not a disastrously weak environment for demand. It's just way weaker than we're used to, right, for the last few years. I also made the point, and I will look back in a moment, but I did make the point, I made the mistake of saying on Twitter in March that I thought that was the low point for home sales for this entire cycle. I thought March marked the lows, and we would start seeing home sales increase off of that. And man, did I ever get hate for saying that. If you ever want to get a lot of hate, say anything positive on Twitter, you'll know about it. And so I made that mistake of saying I think that was the lowest, I think it's going to improve from here. And so just to dunk on my haters, I was like, hey man, look where we are. We are way up off those March lows, especially in Ontario. This is home sales adjusted for seasonality. We're way up off those lows. Okay, so when I say seasonally adjusted, we all understand the room that home sales is a seasonal cycle. There's a lot fewer home sales in December than in May. So economists adjust for that. When we compare across time, we seasonally adjust that volatility out. So we're doing well. I believe we hit low in March. So I think sales are starting to take up. But remember I said we did a lot of pent-up demand building. So really what do we need to unleash all that pent-up demand? It's really two things. We need improved affordability. No, it's not rocket science, we all understand that. And we need a return of confidence. Notice on the left, what's a simple way to visualize the affordability picture? Is to look at, well, what is the monthly mortgage payment that you need to buy into the market today, given where house prices are, interest rates are, et cetera. Because remember, people buy mortgage payments at the end of the day, right? Everyone's always like, well, house price to income. It's like, no one in the history of Canada has ever been like, hey, this house is 6.4 times my income, but I really wanted to buy it at 6.1. Like, nobody thinks that way, right? It's like, what is my monthly payment, right? And so, this is a simple way to look at it. Notice we had that monthly payment spike in kind of coming out of COVID, and with the interest rate rise. There's where we are, and then you can see the dashed line is where we're going to be if we get one more rate cut. That's where we're going to be. We're already back to affordability levels that we saw in 2021. Now, 2021 was not a great point for housing affordability, and yet home sales were 50% higher than they are currently. So the affordability issue is not new. But the demand picture was dramatically different the last time we were at this level. So my question is it really affordability or is it more confidence? It's a mix of both, but I think the confidence is important. And unfortunately, we're just not there yet. I showed you at the beginning the chart on consumer confidence is very soft. If you drill down on the real estate component specifically, you can see real estate confidence is still quite weak. So what's going to turn that around? Well, I think a couple more rate hikes, rate cuts will help. I'm going to get glued off the stage. So a couple more rate cuts will help. And I think if we get some semblance of a resolution of this trade tension, I think that this confidence is going to come back. And so I think home sales have bottomed. They're going to get better. They're probably going to get better slowly. But at some point, once affordability improves a little bit, and that's probably more of a late 26 story, I think you're going to see sales come back stronger than people expect because there's clearly some pent-up demand here. I'd also make the point that, at this point, we know that house prices are down quite a bit off peak. about 18% nationally. This is already the steepest house price decline up peak in Canadian history for at least the 50 years of data that we have. How much more do we think we're going to go? Like, is this the time we get really bearish on real estate when you get prices down this much? Like, that seems counterintuitive to me. So I do think we're close to the point where people start seeing value and stepping in. All right, point number 2. We're going to drill down into some specific segments. I am worried that the single-family segment in the big metros, specifically here in Ontario, is going to tighten more than people realize in the next couple of years. Okay, so if you take a snapshot of the inventory in a lot of big metros across Ontario, single-family inventory on for sale today is still quite high. So you can see I've highlighted Toronto as an example, that the black line at the top of the chart on the left, that's this year, 2025. That's how much inventory is on the market. A lot. Okay, we're looking at 20-year highs for the amount of homes for sale. You can be lulled into thinking that we're in like a permanent phase shift where we're just going to have a lot of inventory forever. I don't think that's going to be the case. And the reason for that, if you look at the chart on the right, this is building permits for single-family homes in Ontario. So remember, before you can start building a home, you've got to get a permit from the municipality, which is not easy, but you know, that's what you have to do. And so what we're looking at is a leading indicator of where construction activity for single family is going, and consequently what new supply of single families can look like down the road. We're back to 1980s levels of permitting activity for single family. So if you're rocket science here, if I'm right that sales are going to start perking up, not dramatically, we can see a grind higher for early next year, and you're going to get a lot fewer new completions, this chart on the left is going to start to tighten. This is significant. So the message I would say is if you are in the market for a single family home, if you want to trade up, right, or if you got kids that want to buy, but they're like, oh, I'm just going to wait for another 5% off, like maybe you're going to get that, but alternatively, maybe this market's going to tighten quicker than you think. I don't know, but I can certainly paint the case where this is going to tighten in 2026. So that's my second point. Third point is where I may get booed off the stage a little bit, but again, I'll bring you the truth here. I'm optimistic on the resale market. I think resale demand is going to perk up. Unfortunately, I think rental demand is going to be a little bit soft in 2026. Okay, so it's going to take a little while to work through this kind of phase shift that we're experiencing. This chart is just showing the annual change in apartment asking rents. This data from Stats Canada. I don't know, there's Red Panda has got a booth out here. I know Hart really well. He's a great source of intel, and he's got much more current data on what's happening. And it's soft. We know that the asking rents are a little bit weak. So let's just talk about why that is. It's important to understand what's driving this. And I think a lot of people miss that we are in the midst of a historic rental construction boom in this country. We went for decades where we didn't build a lot. And then in typical Canadian fashion, we panicked and now we're building up a ton, right? So we love to swing to extremes on both sides. This is the national number. The chart on the left, these are the number of dwellings under construction by different property types. So you can see the grayest condo with peak, that's not coming off. But a lot of condos still being built. And a lot of condos in the next couple of years. The blue is single family. That's really interesting. We are not building any more single family homes today than we were 20 years ago. So that's interesting. What we're building a lot more of is rentals. You can see that's the orange line going up. You see, okay, that looks like a big number, but help me to contextualize that. The chart on the right is just showing if we took that number and we expressed it as a share of the existing rental supply, and we're talking about purpose-built rentals. Okay, so I'm not talking about like condos that are rented out that were never meant to be rentals. I mean stuff that are built explicitly to be rentals. What we find is that what's under construction, if you go to places like BC and Atlantic Canada, is like 14 to 16% of the existing supply. Which is, another way of saying that is in the next couple of years, as these complete, rental supply is going to expand by 16% in places like BC. That's a lot of supply, okay? A little less here in Ontario, but we're still talking a little north of 6%. So we're going to have a 6% expansion in purpose-built rental supply in the next couple of years. That is a historic amount. But again, let's contextualize it. Well, what does this mean in terms of the demand situation? Well, spent a lot of time talking about population growth and immigration policy in the country. I've testified twice for the State of Canadian Finance in Ottawa on this. And so I am sort of early in this issue, but look, the chart on the left is really important to understand what drove some of the dynamics in the last couple of years. The black line is total population growth. Okay, so you can see that in 2023 and early 2024, we went through a period of time where we were adding 1.3 million people to the Canadian population in a year, which was, that's a lot, right? So the question is, well, what caused that? So notice that population growth is made up of three things. The gray bar is what we call natural increase. This is just like births minus deaths. So if we have no immigration whatsoever, how much would Canada's population grow? But right now it's basically zero. So we do need some level of immigration, full stop. The blue bar is what we generally think of when we think of the term immigration. This is permanent residents coming to Canada, settling on a permanent basis, contributing to societies, all that good stuff. Notice that that blue bar from 2020 to 2024 was pretty constant. That really didn't change much. All of the crazy increase came from this orange bar, which is our non-permanent residents. And this is really important for you folks that are landlords in this space. Non-permanent residents, what are we referring to here? Work permit holders, international students, and asylum claimants. Those are the three buckets, but really the big two is international students and temporary workers. And notice that for a period of time in 2023, we were adding 800,000 of them in a single year. That's 800,000, well, let me ask you guys, are temporary residents, are they owners or are they renters? They're all renters. So we added 800,000 renters to the Canadian population in 2022, 23, 24. Right? That per year. So what do we think that's going to do to the rental market? It went crazy, right? And so now we're at the point where the government has said that was too much, too fast. You can agree or disagree with them, but this is their policy. Like that was a little too much. We need to rein that in, and we're seeing now where they're just making changes to a lot of those policies. They actually have the stated goal. The chart on the right is showing this non-permanent residents as a percentage of our Canadian population, because they are counted in our population data. We hit about 7.5%. The government said we want to get that back down to 5% in the next couple of years. We're going to do that by significantly tightening the inflow of people coming into the country. This is why you're seeing a lot of community colleges really screaming that the student numbers are down internationally. If you're a landlord, you've got to understand this dynamic. Okay, this is going to play out over the next year. We're seeing in the data, this is the quarterly change in non-permanent residents. They are now declining. And as it relates to us here in Ontario, unfortunately, we levered a lot of our population growth off of this dynamic. And so you can see this is the 2-quarter growth in Ontario's population. You gotta really squint to see it, but on the far right is the teeny little wee bar that's almost zero. So in the last 2 quarters, Ontario's population is basically not growing. Okay, so, and we haven't seen that in 70 years of data. So if you're wondering why it's a little bit of a soft rental market, well, we've got a lot of supply that's coming, and unfortunately we've got weak demand in this key cohort of this temporary residents. And that is probably going to be a story through most of 26. And so, let me go back. So the key takeaway for folks in the room, if you are a landlord and you've got tenants, keep them. Okay, keep them, because if at turnover, you're probably going to be resetting the lower rates, the lower rental rates, unfortunately. This is the reality. So it's probably going to be this way for another year. Okay. So that's the data. Let me, one more, I got 10 minutes, so I'm going to do this, and then I'm going to give you the bonus takeaway. There's a lot of fear and pessimism around the condo market right now. It's all warranted. There's a lot of condo supply. I showed you the chart of what's being built. A lot of new condo supply. We've got about 4 quarters coming up where new condo completions are going to be at or near records. There's a lot of condo supply coming. Chart on the left is showing what's for sale in Toronto, just as an example. A lot of condo inventory currently on the market for sale. A lot more coming based on what's currently under construction. So you get probably 4 quarters where there's a lot coming. However, I want to make the case that in a few years, the conversation is going to turn not to this current oversupply, but to an undersupply crisis in condos. Why? So before you can build a condo, developers have to pre-sell typically 70% of those new condo units. And then they go to the bank, they go, hey, we got all these commitments to buy, give us the money, and then they start building. And so another way of thinking about this is new condo sales, pre-construction condo sales, tell us where construction activity is going to be typically 18 months down the road. What's happening with new condo sales right now? I mean, this is a well-publicized story. I'm not telling you anything you don't know, but I mean, you can't give away new condos right now in Toronto. Nobody wants to touch them. New condo sales right now, like you can see that's year-to-date, January and August. I mean, barely, like we're like 1,500. Normal year, you're 15,000, 17,000 by now. It's like 90% for a normal year. So this is very few new condo sales. The chart on the right is showing this on a 12-month rolling basis. Really simply, what this is telling us is that in the late 2020s and early 2030s, we're going to be looking at new condo completions of probably 2,000 a year annually for a couple years running, which I don't care how bearish you are, how, your most pessimistic estimate of demographic demand, that's not going to be enough. It's not going to be enough. And the problem with condos is they're what we call inelastic supply. Right? So the idea there with inelastic supply is by the time we realize we built too many, which is kind of where we were in 22, 23, we're like, oh shit, we got like 3 or 4 more years of a lot of them coming. We can't just stop that trend. But the opposite is also true. By the time we realize we don't have enough, it's another 5, 6 years before you get your stuff done. So that's the reality of the condo market, and I think that you roll this forward a few years, we're going to be undersupplied. There's going to be a great. I know Tom and Nick are not keeping like condo all about cash flow, but I'll just tell you, I think there's going to be an interesting opportunity to own condos. Not this year, probably not 26. The price is probably going to be a little lower, but at some point between kind of 27, 28, I think we're going to have the bottom of the condo market, and I think the 2030 is going to be quite a wild ride. So, okay. Bonus one, I got 7 minutes to wrap this up. All right, all roads lead to currency debasement. It's always one. So let's talk about this. We understand the debt situation in Canada. This is a global issue. There's a lot of debt out there. I think people sort of underestimate how much debt we actually have in Canada. Chart on the left is just showing total non-financial sector debt relative to GDP. So we say non-financial, this is like households plus all levels of government plus corporations. We're a very indebted country. You'll sometimes see headlines that say that Canada's federal debt is really low relative to the rest of the world. That's highly misleading for 2 reasons. As an aside, I'll just say it real quick. Number one, very few other countries in the world get to offload the cost of education and healthcare to their provinces, right? So that's a big one. Like if the states got to offload all that, like the federal government got to offload education and healthcare to the states, their debt would look very different. The second one that people don't realize is every time you hear that reference around federal debt being low, they use what's called net debt. So the government says, yeah, we borrowed all these hundreds of millions of dollars, but over here is Canada Pension Plan, which is technically our asset, and so we'll offset that against the debt. Now, how many people in this room would be comfortable with the government being like, if we had to repay our debtors, we'll just take your pension money and settle that? Like, no one thinks that way, right? But when we do this accounting, we let the government net out those pension assets, which is crazy. So the right way to think about it is what's the gross debt, and what is it relative to GDP? And here we are. We're in the rarefied air of the 300% club, and we know that deficits are going to be really big. We don't know how big. We're going to find out on November 4th, but there's whispers about potentially a $100 billion deficit. I think it's probably going to be more like 70 to 80 billion. You're talking, that's like still 6-ish% of GDP. That's a huge number historically. Now, all right, how do countries deal with their excessive debt problems? And also, let's be honest, we have excessive debt problem. It was not an issue for years. It's becoming an issue. Follow the bond market, these guys do. There's some jitters globally around these deficits. You're seeing people are starting to get nervous around the amount of debt in the system. How do we do it? 4 ways. Number one is default. So they're like, wow, we know we owe you this money, but we're just not going to pay you. Never popular, and frankly, it is not going to happen at the federal government because they can always print the money from the Bank of Canada to repay it. Mm-hmm. So you'll never have a technical default. They can just print it. Here's your money that we just printed for you, right? And they're like, well, this doesn't buy me anything because your currency's now worthless. And they're like, well, sorry, that's your problem. So that's always an option for the government. So default's not going to happen. So the second one that if you're going to pay like a positive price, you can say, well, maybe we'll get a major increase in income and productivity, and that will grow our economy and our wealth, and we can repay that without it being burned on us. It's entirely possible. This AI revolution, we don't know how real it's going to be. But man, we're talking about big numbers. I'm doubtful that this is going to be the way out, but at a minimum, we can't count on it. And historically, this has not been the case. So the third one is what we call austerity, which is just like, hey, listen, we're all in this together. We got to cut spending. We got to tighten our belts. Never popular, right? This is like, if you want to run this as a government, you get one term at best, and they boot you out. Okay? So this is like, extremely unpopular, it almost never happens, it's a great way to lose an election, so like, let's just say that's it's possible, and by the way, not fun. To live through austerity, where they're cutting spending, it's not a fun time for the economy. So that leaves us with the fourth, which is debased currency. So in other words, we just do this, we say, well, we know there's a lot of debt out there. What we'll do is we're going to let inflation run a little bit hot, we'll keep interest rates a little bit below that level of inflation, and over time, the economy is going to grow artificially, and we'll just repay that debt with slightly inflated dollars. It's another way of saying we're just going to steal from old people slowly. And by the way, which one's the most popular? Which one's the one that's happened historically? It's always this. It's always this. And you know, this is one of those things where it doesn't matter until it does. And we're at the point in the cycle where you can see countries are realizing this is the way. Okay. So the question is, what does well in this environment of debasement? Oh, actually, before we get to that, let's just talk real quick. I love new conspiracy theory. I think this was one of the most under-recorded stories from a couple of years ago. In Canada, we used to issue bonds that were tied to inflation. So we would say, if you lend the government $1,000, at the end of 5 years or whatever, you're going to get $1,000 back, plus whatever inflation was. So if cumulative inflation was 10%, give you another 10%. Because we're going to connect what you owe us to inflation. And then very quietly in 2022, everyone said, we're not going to do those anymore. Why? What a weird thing. What a great product for protecting retirees from the vagaries of inflation. The government said, we're not going to do that. And then you get a couple years later, the Bank of Canada comes out and says, maybe that 1 to 3% inflation target, I don't know, maybe it could be like 2 to 4, maybe 3 to 5. Does it have to be 1 to 3? These are the things when you're looking for signals of how governments are thinking. They never just drop a bomb on the public and be like, boom, change the inflation mandate. They like float ideas out there and let people digest it. So this is the sort of thing that I notice. And so what does well if we are going to appear to debasement? Well, commodities, so we already talked about basic precious metals, I know our core part of Tom and Nick's portfolio. Stocks with real assets on the balance sheets or with significant pricing power, so I'm not here to give stock-specific tips, but like generally things that well, we'll talk about it in a minute. International stocks, emerging markets, Bitcoin would do well, and of course real estate, because you can't inflate away real estate. You don't have a printer that creates more real estate. Okay. What tends to do poorly is cash, obviously, long-term government bonds, those IOUs for the government, they're going to screw you on those. They get repaid, but all those dollars you get repaid, you're going to buy a lot less. And oftentimes growth-oriented equities, so things like tech, things that don't have a lot of tangible assets, that have long returns, they tend to do a little poorly. So this, I think, is the environment we're coming into. I think Tom and Nick, I don't put words in them, I think they largely agree. And I can stop there. So my company's Edge Analytics. You can check us out at edgeanalytics.ca. There's a discount code there if you like reports, you like doing quarterly conference calls and strategy sessions. All that's there for you.